Good day, fellow investors. Berkshire earnings are out. Berkshire is a covered stock on this YouTube channel. It is also part of our YouTube portfolio, so I've bought a small position relative to other acceptable positions on the portfolio, so just $10,000. It is up 8% since I bought at an average price of $278, but it's always cool to watch. Berkshire is a great business. We'll update now on earnings, and if it goes lower, I'm happy to buy more, but that's also investing. Sometimes what you buy simply goes higher and higher, no matter the price what you paid, or the valuations, or the fundamentals. This is on Interactive Brokers. If you want to support the channel, you can click on the link in the description to check for a global broker that allows you to invest in all the markets in the world practically. But back to Berkshire, if we check the stock price, the stock did really well over the last 5 years. Surprisingly, when the market started going down at the beginning of the year, so year to date, Berkshire actually continued to go up for a while thanks to its safety, as people and the market fled to value. They wanted security, but then again, Berkshire also dropped. And now it is flat for the year, which is still better than what the market did. The market is 10% down for the year. The market capitalization is 661 billion, and the price earnings ratio is now 0 because Berkshire, accounting-wise, didn't make any money, but we'll discuss that too in a moment. So, up, down, 661 billion, remember that number later for valuation. Let's go now to the earnings. Now, when you look at Berkshire's earnings and you see here second quarter investment and the derivative gains and losses, 67 billion. So in that quarter, Berkshire lost 67 billion. And then how come? Well, you have to look at Apple, which is Berkshire's biggest position, and then look at the moves over the quarter. So from the end of the first quarter till the end of the second quarter, Apple was down 21%. And if Berkshire has a 100 billion position in Apple, that's 20 billion loss. And if Berkshire has a 150 billion position in Apple, the 150 billion, 20% down, that's already a 30 billion loss. Plus all the other positions that Warren Buffett has in its portfolio that went down during the quarter, and that is why you see an accounting loss here. But if you look at the reality, and that's always what Warren Buffett says in every report, you have to look at the operating incomes. This is before income taxes. In the yearly report, you'll see after income taxes. So Berkshire made 10 billion in earnings from businesses, from normal things, and you have to exclude this $67 billion decline, because sometimes there will be a positive, sometimes there will be a negative, depending on how the stock market goes. But Warren Buffett is focused on these numbers, the operating earnings, and if you compare the first 6 months, you see, okay, small growth, 4-5% earnings growth, in line with what we have predicted in our model that we'll discuss in a moment. So don't get confused by the accounting losses. What matters is how much Berkshire made, and that is 10 billion in operating earnings for the quarter. Let's now check and recheck, nothing to recheck, but check our valuation, because Berkshire is really a fortress of stability. If we go to our public table that you can download in the description below, we have Berkshire here. We click on the valuation table, and I have used 36 billion in earnings for Berkshire, and that is 15.67 per B share. If they keep growing at 6% discount rate, I expect a 10% return, let's say, then the intrinsic value is 153. That is much below the 278 current stock price. If they grow at 8% and the market gives them a price earnings ratio of 25, which is a little bit exuberant, it is usually 15 for Berkshire historically, 25 is exuberant, then the stock is fairly valued for a 10% return. But now we can say that Berkshire is valued for a 5% long-term return 4.5. That is Berkshire. We have to adjust that discount rate. So to get to explain why Berkshire is valued as is, and that's also a reason why I opened just a $10,000 portfolio, because I want to follow it here on YouTube and then see where it goes. If it goes 50% higher, I might even sell and materialize on the 5,000 gain. Here, we'll see that over time. Compared to, I don't know, better risk and reward that we have done, we have spent more on WBD. This will be discussed in the next 2 weeks. Meta coming soon. ADM also will be discussed in a few days. So some random thoughts on Buffett. Berkshire is a huge business. It represents the American economy, plus Apple, plus the stocks, plus the dividends. So it is a fortress of stability. And at the beginning of the year, people were looking at it, flocking into it, but usually at the wrong moment in time. Okay, it did better than the S&P 500, but that is, again, short-term voting, as we discussed yesterday, compared to long-term weighing. Now, the usual comment when it comes to Berkshire is what happens after Warren Buffett retires, because he is a little bit on the old side. And then one comment is always, as Buffett said, you always need to buy a business that an idiot can run, because sooner or later one will run it. In Berkshire's case, you always need to buy a business that one with dementia can run, because sooner or later one with dementia will run it. For now, that's not the case, but I also made this video for those interested in understanding more about Berkshire and what happens if Buffett retires. Now, when it comes to capital allocation, of course, the Buffett magic will go away likely, but they can do buybacks, as Apple is doing, as Facebook is now doing, and that will always keep the 6% growth on the conglomerate. So nothing to worry when Charlie and Munger retire. Thanks for watching. I'll see you in the next video.